Does the fact that we've seen a bit of an improving trend filtering through warrant any excitement right now, or is it still too early?
I think it's great. I mean, it's been a terrible time in the residential sector ever since somewhere in 2008, I guess. So any improvement is good news. But 2.7% year-on-year house price inflation at this stage, it points in the right direction. That's great. It points towards a better 2010. But in real terms, that is still a decline because consumer price inflation is up nearer to 6%. So as yet, still not a wonderful market, but we have seen steady improvement as 2009 progressed.
Let's take a look at some of the factors that we need to consider here. I mean, what you see propelling this market moving forward. First and foremost, we've got banks lending and, of course, the interest rate direction to consider. What are your forecasts on those fronts?
Well, firstly, okay, for house prices, my projection for the year is 8% average. That is a big turnaround from minus 3.9%, but it's certainly a far cry from a few years ago during the boom years. We see the economy coming out of recession, and that should help in terms of minimizing the job loss initially and hopefully job creation later in the year. But we're looking at between 2 and 2.5% real economic growth. So more support, but not fantastic support compared to the 5% pluses a few years ago. And then we still have the full impact of interest rate cuts that has to come through, especially in the first half of the year. That would probably wear off late in the year, but at least for the first half, there is still significant stimulus there. So that's the improvement. But why we don't expect miracles during the course of this year and why we're still looking at single-digit house price inflation is because against that we have a high household debt to disposable income ratio. So off that high base of indebtedness, you can't expect a household sector to grow its new borrowing at a rapid rate like it did earlier in the last decade. So that moderates the sort of recovery that we can expect for. I think that double-digit house price inflation realistically is probably a few years off.
Looking at, you mentioned one of the push factors here, debt to disposable income ratios. I mean, they remain high. When do you see some of that tapering off and down to a level that would actually stimulate and ignite a more impressive property market?
Well, the trend downward has started. The peak was reached in the early parts of last year. Oh, sorry, it's now early 2008. And then there was a decline in 2008, but the recession put such pressure on income that ratio actually rose again for a while, and now more recently has started declining. It's still very high, but I think the declining trend has started. One has to be patient with this deleveraging, as they call it, in the household sector. The last big downward trend started somewhere in 1998, early 99, and was about a 4-year downward trend. So that's probably what we're looking at yet again. And to be at much more respectable levels of indebtedness, off which credit growth could grow very strongly, possibly takes us to about 2013 or so, somewhere thereabouts. And if you had another interest rate cutting cycle at that point, then you could see nice double-digit house price inflation, which we haven't seen now for a few years.
Having said all of that, and bearing in mind that you did emphasize that we still need to see the full effects of the full 5 percentage points of interest rate cuts we've seen thus far, what's your outlook as far as interest rates in South Africa are concerned? Do you think that we need to see a cutting of rates at least once more this year?
Well, it is possible, I guess. I wouldn't count it out, but our forecast for the time being are that rates will stay where they are for much of this year and start rising very late in the year and into 2011. A very mild interest rate hiking cycle, because with the sort of mediocre growth expectations and not much, a mediocre global growth expectation as well, we don't expect a big inflation surge. So that would be mild hiking. But at the moment, we're not expecting, or the most probable scenario for us is not further interest rate cutting this time around.
If we shift focus and look at supply, I mean, we've seen many sit tight on their properties while developers have continued to build, albeit at a much slower pace than we've gotten used to in the past. What supply-demand dynamic are we looking at in the housing market?
Well, at the moment, I think in many areas there's still something of an oversupply. I think it's gradually being mopped up, and hence you're seeing the start of national house price inflation, well, in nominal terms at least. But the problem for developers, it's been a problem for developers, but it's been something that's contributed to the slow curbing of oversupply, has been that a few years ago there was big input cost inflation. So it has been very difficult for developers over the past few years to bring competitively priced stock to the market. That has slowed new developments quite dramatically, and I think it's going to be slow on that front till at least late in this year. I think only very much later in 2010 may we see positive year-on-year growth in the building numbers. So gradually the oversupply is being mopped up, but I think my gut feel is difficult to know at what point it has been mopped up. I think when you're in nominal house price inflation, but where in real terms you're still negative, there's probably still something of an oversupply existing.
Is there a distinction to be made between the various house categories that we have and how dynamics within those various segments are actually playing themselves out?
Well, we can, if one looks at the cycles over the various price categories, I go more on area value bands than prices of properties, because cheap properties in expensive areas tend to behave more like the expensive areas. But we've got four bands, and what we found is that the highest price band has generally led the cycle over the last decade or so. We had big interest rate cuts early last decade and in the late 90s. Suddenly demand shifted up the price ladder because we could all afford a better house than what we previously could have. And so the highest segment peaked first somewhere around about late 2003 in terms of house price inflation. Then, of course, I guess prices there overshot the mark a bit, and the demand started gradually shifting downwards in search of better value for money. And what I call the affordable housing sector only peaked as late as 2006, a few years later. They've all been in the doldrums in 2009. But I think, again, if we look at volumes, the highest end of the market is the one that has recovered a little bit earlier than the others, or started recovering a little bit earlier than the low end. And I think, too, if one looks at where the financial stress has probably been most felt, that's been lower down in the lower income group. So hence, that's why that affordable segment is possibly still a bit weaker than the highest end.
Looking at activity and who's active and who's not, one would assume that we'd have to differentiate between primary residential demand, long-term investment demand, and then pure speculators in the market as well. Are you seeing pretty different trends emerging from those three categories?
Absolutely. If we look at our most recent property barometer surveys, where we survey agents on such matters, certainly the buy-to-let market does not look wonderful. It hasn't shown any meaningful improvement just yet, according to our surveys. I think for the time being, with the household sector still under financial pressure, it's about essentials. That means primary residential demand being the very, very dominant driver. Things like buy-to-let, well, yes, long-term investors, people who are in it for the long haul, maybe speculators, I think
certainly
very
not
few.
Speculators who are in for 2010.
No, you know, a speculator often uses credit when there's rapid house price growth to borrow and make short-term capital gains and then sell again. That's not likely in the near future, I don't believe, because there isn't rapid house price growth at the moment. And then, of course, holiday demand too, I think, will be quite slow for some time. So I don't expect impressive performance in strongly holiday-driven areas just yet. It's really about basics, and it's about essential buying at the moment predominantly, I think.
While we know that the recovery is going to be a slow and steady process, I mean, do you see us getting back to levels that we saw back in 2004, where we saw, 29.5% average price inflation being registered?
No, well, you can never say never, but I think that would be many years off. One must appreciate that was special circumstances. We'd seen inflation come down over almost 2 decades. I'm talking about consumer price inflation. When the SARB switched to CPI inflation targeting, suddenly there was no longer a need for those crazy high interest rates of the 90s, and we had massive interest rate cuts. I call it a once-off structural adjustment. Now, it's very difficult to see interest rates being cut by that sort of magnitude again off where we are now, so at some stage in future. So no, that was special circumstances. When we talk about booms in the future, I think we're probably talking about house price inflation in the teens. If you reach 20%, you'd be doing very, very well. But 30% plus, well, that's pushing it, I think.
On that note, let's leave it there. John Loos, thanks so much for your time this afternoon. And of course,